Yo, what's up? What's up, guys? This is, I bet, this is like the simplest, easiest. I don't know what more I can call it, but this is like the simplest introduction to forex ever. I can tell you. If you know nothing, if you're just starting out forex for the first time, if you've really not understood these things, you see them, they make you feel like, bro, what is this? Is this another language or something else? If you've been seeing candlesticks, if you've been seeing, so most people want you to pay for this content, mentors, gurus, they want you to pay for this content. But today I'm actually starting off a program that gives out this content for free. It shares all the secrets. It's not paid. It's just actually the actual thing you need. And it's one of the simplest and most realistic ways to learn trading. Just come to FX for Love, subscribe, turn on the notifications, and make sure you're tuned in for the best content. The best content, remember. Yeah. So we're gonna start off like this is the simplest introduction to Forex ever. Like Forex. So everyone is like, Forex, yo, what is Forex? You have been hearing Forex trading. Guys are making a lot of money off Forex trading. Yeah, in short, they call it FX. Like, you like to see these guys call themselves like Billy Ritchie FX, Hobby FX, FX, Dovey FX. Like, there are lots of FX names. So, what is Forex? Forex is basically foreign exchange. Yeah, so in short, it's the global marketplace where people trade one currency for another, aiming with the aim of profiting. They aim to profit. So nobody trades Forex just for the sake of trading Forex. They actually trade Forex to profit. That's what most people do. So here we have an example of talking about the euro stroke the US dollar. So at a price scale of 1.100, it means 1 euro costs about 1.1 US dollars. So, and definitely you can do your own research and find out that the euro is greater than the dollar. So you're seeing here that in order for you to exchange 1 euro, you need 1.1 US dollars. So when you trade Forex, you're always buying one currency and selling another at the same time. So this is something people find confusing, but I actually make it simple by saying, in Forex trading, we trade currency pairs. That's something I want you to know. We never trade a pair. We never trade one currency alone. We trade a currency pair. So that's why we actually buy, and when you're actually buying one currency pair, you're actually selling the other. So at the same time, so it's simultaneous. It's nothing like you buy this one and then after buying you go. So you trade a pair, you're gonna find US dollar, Japanese yen. You're gonna find euro, US dollar. So we are trading pairs. We are not trading just a single. So as you choose to buy a currency pair, like let me say euro USD, if you click buy on euro USD in your charts, you're buying the euro as well as you're selling the dollar. So you're buying one currency and selling another at the same time. You're not just buying only the one you want to buy. So that's not how it works. It's simultaneous. So next thing, second of all, how do you profit in trading? Because people come to trade Forex with the aim of profiting. So how do you profit? So you profit by correctly predicting whether a currency will go up or down in value against the other. So if you believe the euro will rise against the dollar, you buy the euro and you sell the dollar. So as you're buying the euro, if you expect the euro will increase in value, you buy euro USD. But when you're buying euro USD, what's happening? You're buying the euro and you're indirectly selling the dollar. As you remember, I said in trading Forex, you buy one currency and you sell another at the same time. So if you're buying the euro, because in a pair there are two criteria for a Forex currency pair. The first is the major and the second is the minor. So in euro USD, the euro is the major and the US dollar is the minor. So whenever you choose to buy, you're buying the major and you're selling the minor. But it's not the opposite way around. So, and remember, the major is usually a pair which has more value than the minor. That's why it's made the major in the pair. So the euro holds more value than the US dollar. That's why the euro is the major in this pair. So if you, for example, if euro USD goes from 1.100 to 1.1050, that's a 50 pip rise move. So pips, you guys will get to understand pips in my next coming videos. So this is just a basic introduction, so I don't want to dive into pips, but that's a 50 pip rise. So you profit depending on your trade size or your lot size. Yeah, so in Forex, we have what we call lot sizes. A lot size is like a contract size, like a position sizing, like whereby if you choose to buy the euro, if you choose to sell the euro, there is a size you can choose to do it at. Like I can choose to buy a euro using 0.01 lots, using 1 lots, but you get to understand that. So if the market moves against you, you take a loss. Like if I bought the euro expecting it to increase in value, to go up, and the euro goes down, I actually make a loss because I've bought at a price expecting the price to increase, but instead of the price increasing, what has happened? The price has dropped in value. So meaning I've lost value. That's why I take a loss. And with selling, it's definitely the vice versa. If I sell in the market, I'm expecting prices to go lower. And as I am selling, I am buying the other pair indirectly. As remember, I told you it's a simultaneous act. It's not independent. So if I'm selling and expecting price to go lower and price goes up in value, I definitely make a loss. But the question is, why do I make a loss? Because some people find it confusing when I say I'm expecting price to go down and I'm selling to make a profit. You get it? And price goes up. How do I make a loss? Now remember, when you're selling, let's say for example, you're selling the euro US dollar. When you're selling the euro, you're expecting the value of the euro to go down. So let's say you bought the euro and you're selling it off. Like people are selling off positions and you're expecting the value of the euro to go lower. But when you're selling the euro, what happens is you're indirectly buying the power of the US dollar because you're expecting to benefit from that point in time that the euro is actually going down and the dollar is gaining value. So if the opposite happens and price, the euro buys or the value of the euro goes up instead of going low and you're selling, you make a loss. Now, why do you make a loss? Because the opposite happens. You make a loss because instead of the dollar gaining value, the dollar gains loses more value, which you are converting value for by selling off your euro to gain value of the dollar. So what happens is instead the euro gains value and the dollar loses value. So that's how you end up making a loss. But I will explain it into details further. So to control losses, traders have what we call a stop loss. And a stop loss is an order meant to lock profits, meant to lock a loss so that it helps you avoid losing more than you expect to lose. So if you trade without a stop loss, definitely you can blow your whole account. And to lock profits, we use what we call a take profit order. So I'm going to have a video talking about orders, buy limits, sell limits, stop limits. But basically, to control losses in trading, we use a stop loss. So that's why I tell people Forex trading is not gambling. It is you who gambles on the markets. But trading is not gambling. If you use proper risk management and use a stop loss and use a take profit to take profits, like, bro, you're not gambling and you'll end up making it out. So third of all, market players. So the question is, we talked about how do you profit in Forex. But in this Forex market, we have market players and their impact. So different groups participate in the Forex market. It's not just only you who wants to get into Forex. We have the first guys. These are the big boys like the central banks, e.g. the US Federal Bank, the ECB. These guys play a role of controlling interest rates, stabilize currencies. The impact is they create really huge moves with rate decisions and interventions. So with the central banks, these guys move the market. They trade billions. They trade hundreds of millions of dollars. So you are nothing compared to them. You don't make even a 0.01% fraction of the money they trade. You're going to put in your $10 like, bro, your $10 is like your $10 is like really very small. Yeah, it's like nothing. So the second guys you have after the central banks are the commercial banks. These might be your banks in your home country, the Stanbic, the Centenary, the Equity. So these guys provide liquidity and handle large transactions. So they keep the market running. Like that's why they also have like mini Forex bureaus inside them, the exchange currencies. Those are your banks around you. So after that, we have corporations or businesses. These guys convert money for imports and exports. They cause regular demand and supply flows. Next of all, we have the hedge fund investors. The hedge fund investors, they trade large amounts of profit. So these are like trading institutions. Like some of them are legit, like you can, if you have really huge money, you can invest with them and they manage it for you. They manage the losses and the profits as well. So they can push trends when positions are large because these guys also trade huge funds, the hedge funds and investors. Like these are Wall Street traders. You go like to USA, we have the Wall Street, like there are those hedge funds managers, those investors, like these guys are also big. So You guys, here you are finally. Like, this is us, retail traders like us. Like, we speculate with our small money. We put in our small money, $10, $5, $100, 1,000, $10,000 at the beginning. These are basically us, retail traders. We speculate through brokers. We have a small share, but we add a bit of liquidity and volatility into the market. Fifth, we have the brokers. The brokers, these guys basically are middlemen, connecting us, the retail traders, to the real Forex market. So brokers are the middlemen. Like, when you have your money and you want to actually buy the euro, you want to buy the dollar on your phone, you want to be able to trade Forex, a broker is what helps connect you to the market. So without a broker, like, bro, there's nothing you can actually do with your money. So brokers provide access, spreads, and leverages. So moving on from the market players and their impact, we have to talk definitely about Forex market time frame. When is Forex open? So Forex is a 24-hour market open Monday to Friday. That is 5 days a week, 24 hours, 5 days a week. It never sleeps because when part of the world closes, another opens. So this makes Forex unique because of the different time zones we have as different countries. So it makes it unique compared to stock markets because stock markets have fixed opening and closing times. Like, if this time the markets are opened, like, there's a time at which they close and the time is fixed. Like, it's not open like 24 hours, 5 days a week. So that is the Forex market time frame. Meanwhile, if you know the Forex market time frame, you need to know that in the Forex market, we have trading sessions and best times to trade. You don't just trade anytime you feel like trading. Like, bro, maybe if it's your setup, but I bet you'll not get good results. You'll not get the volatility, the momentum, like the volume. So if you're looking for the volatility and the volume, when I mean the volume, large contracts are being exchanged, large trades are being made. When I mean the volatility, how fast can value increase or decrease among different currency pairs? So Forex market is basically divided into 4 main sessions, but this is based on the UTC. Times here are based in UTC. Although in my next videos, I'm gonna show you guys how to check the time in your country based on your time zones, because you might not want to convert. You'll be like, oh, the time is in UTC. How do I convert that? Maybe it's in East African Standard Time. Maybe it's in Universal Time and all that stuff. Like, I left that. So let's go to the Sydney session. So, like, the first session you need to know about the Sydney session. It's basically 4-hour time, 22 to 7. Here there's lower liquidity. The Australian dollar and New Zealand dollar pairs are active. So we have the Tokyo session. This one is usually also around midnight to 9. So here the yen pairs are more active, like pairs that have Japanese yen in it. But generally they are slower, they are range-bound moves. London session, that's Europe basically. We got 8 to 17, most liquid and volatile session. So pairs involving the euro, the Great Britain pound, like these pairs move strongly in the London session. So in the New York session, which is about 13 to 22, it's driven by US news releases like the NFP, the CPI, the PPI. Like here, bro, it has volatility and volume. But the best times to trade, usually I'll tell you, are the overlaps between the London and the New York session. So best overlaps to trade, we have London and New York. We have the highest volume and the best trading opportunities. Like, bro, why should you start trading at 3? Like, bro, 3, 1. Okay, maybe if it's in your time zone, but like, bro, why should you just trade? Like, why should you just trade like at any time? Like, bro, man, like, you need to know when you need to trade. Like, don't chase the markets, man. We have also the Tokyo and London. Good for JPY, which is Japanese yen, and Euro crosses. So, looking at the time frames, guys, why do you get yourself into trading Forex? Like, are you just trading for fun? Did they force you? Like, bro, like, I bet you should be having a reason, something that drives you towards Forex. Like, what are the advantages? Definitely, like, you have a 24-hour access 5 days a week, so you can trade anytime during weekdays. Second of all, high liquidity. Like, it's so easy to enter. Like, bro, if I have a trading position running, it's so easy for me to enter and exit it. Like, especially with these major pairs like gold and all that. Like you can just like I can when I say I'm in loss, like I can just go and close the order. When I'm in profit, I can just go and close the order. Like it's just there within you. So low costs, there are tight spreads and leverage available. So we have even brokers like FBS whereby you can start trading with as low as $2.5, 2.7. That's like very little money, and you can put it in a center account and start to learn how to trade with. So like which business within your country allows you to start a business with basically $2? Like $2, like guys, $2. Which business can you start with $2, honestly? So another beauty is the global market. It's influenced by worldwide events, always there, which means that there are actually always opportunities. So then another beauty of Forex is the variety of styles. Like you don't have to be trading whereby like bro, you're glued to the screen. It's like they got your eyeballs and bro, they use super glue and place them on the screen. Like bro, this shit is not meant for everyone. Like you don't need to always be on your screen, on your phone. So you have to basically find what suits you. Maybe you're the type of guy who has the whole day. You're like free. You're like, oh, like bro, there's nothing I have to lose. Like bro, you can choose to glue your eyes on the screen. You can choose to glue your eyes on the screen. But if you're someone who is trading, like bro, you need the freedom. You want that time. You want to be able to multitask, to do other things. Then bro, you need to adopt a style, an approach that suits your personality. And that's why we have trading styles. So different traders use different trading approaches. So scalping is very short term, many trades per day, looking for small profits, few pips. So what are basically advantages of scalping? I'll tell you, scalping requires huge lot sizes. You have to do a huge risk, but for a small sure number of pips. So that's scalping. You're in for a very short time, 5, 10 pips, 15 pips, you're out. But you've used that huge lot size whereby you make maybe $100 a pip, $10 a pip, $50, $1,000 a pip, and you're out. That's scalping. It requires you to be really attentive, to be most times on your screen. Now, day trading is whereby you open and close trades within the same day. So you avoid overnight risk. So basically, you can hold a trade for 4 hours, 3 hours, 2 hours, the whole day, but you don't exceed the day. The moment the day is done, like you're out of the trade. Swing trading is a time where I can hold trade from days to even weeks. So with swing trading, I can hold a trade for 2 days, 1 day, 2 days, 3 days, 4 days, like that. Basically, even up to a week or even 2 weeks. But position trading is a long-term trading whereby you can hold a trade from 3 weeks, 4 weeks, a month, 2 months, 3 months. So position trading is based on you understanding fundamentals. You can hold trades from weeks to months. You must understand major price movements, major fundamentals. You must understand those key points in the market that make price move. And last but not least, we have algorithmic or automated trading. So this is where they use EAs or trading bots to follow program strategies. Yeah, things like whereby you see guys advertising these trading robots. The bot can make for you, the bot can flip for you. I'm on ABCD. Yeah, although there are lots of scams, but like I'm not trying to tell you, but I'm trying to tell you, like guys, it's good for you to create a strategy, something of your own, your edge, your system, your personal edge, your personal system. Like, bro, I don't want to see you scammed. The reason why I started this channel is to see guys learn and understand that you can actually make money from trading. So in summary, what can I say about Forex? I can tell you guys, Forex, guys, this is basically the easiest. This is basically the simplest introduction to Forex. Like, guys, Forex is just buying and selling of currency pairs to make profit. Yeah, so thank you guys for watching. Yeah, if you're new to the channel, guys, don't forget to subscribe, to like, to share, to comment. Tell me what you want. Tell me what you didn't understand. Like, bro, this channel is not just meant for newbies. Guys who are in the middle, guys who are stuck, psychology, like discipline, like all those things. Like, guys, I'm here to break it down, to simplify it for you, to make it so easy, to share with you the secrets the gurus don't share you. There's nothing here on this channel that's paid for. Like, it's all free. It's all free. Simply subscribe, turn on your notifications. And please, don't forget to. So from here, I want you guys to take that. I've given you just a basic general understanding of Forex trading. What is Forex? And guys, see you in the next one. It's your boy FX for Love.